I must say that I like the topic that we are tackling today, as it challenges the notion that all debt is bad. My name is Busi Ngqondoyi. I am the head of property and hedge funds at Old Mutual Multi-Managers. Today, we are talking about using leverage or gearing to create wealth and the power of leverage. But first things first, what is leverage? I must say that I like the topic that we are tackling today, as it challenges the notion that all debt is bad. Leverage and gearing are pretty much the same thing, and typically means using borrowed money to finance the purchase of an asset or investment. Primarily, people use leverage because they believe they can use the extra money to buy more assets and make a bigger profit. Importantly though, the opposite can also be true, as leverage can also amplify your losses. Let's unpack this a little bit more and share examples of where one can use leverage to get ahead. Let's start off with a simple example, one that most of us maybe relate to. Most people can't buy a house cash and therefore use a form of leverage to buy their homes. This allows them to buy and use the asset without the full capital outlay. It is also generally seen as a form of a forced saving, in contrast to paying rent, as one ultimately owns the house once it has been paid off. As we know, the value of property tends to appreciate over time, and as such, this is considered a good type of leverage. To extend this further, in the listed property space, which is one of the areas of my speciality, property companies do this at a bigger scale and build property portfolios by partially financing them via leverage, the so-called property to loan value. But it's key that this is done in a measured and risk-cognizant approach, as it can also work against you. Investors can buy into listed property funds to get diversified exposure to commercial property. When one talks about using leverage in investing, hedge funds come to mind. So how does this work? One of the key differentiators hedge funds have to traditional or long-only asset classes is the ability to use leverage. This is because, unlike traditional asset managers who can only invest in stocks that they believe will increase in price over time, hedge funds can also make money from stocks that they believe will fall in price without owning the stock. Essentially, leverage allows hedge fund managers to finance their portfolios with short sales of other positions in the portfolio. So leverage is a tool that both hedge funds and property investments have in common, which they use to magnify or amplify profits, and in so doing, create and grow investor wealth. But importantly, they do this in a risk-controlled manner. So how can one take advantage or benefit from this while being mindful of both the risks and rewards it comes with? Well, besides the benefit one gets through their mortgage, home or house, one can also get the benefit of leverage. For example, investing in the listed REITs or listed property space, as well as in fund of hedge funds. At Old Mutual, we, for example, invest in asset classes that make use of leverage, but do so in a controlled manner within the context of a diversified overall portfolio. Are there other ways investors can benefit from leverage, something they can implement without the intervention of a third party? Certainly. Maybe one that again is relevant to those who own a house and have accumulated positive equity in their houses. Given that mortgage loans tend to have lower interest rates in general compared to other types of debt, one can tap into that equity to finance another asset. For example, instead of financing a car through vehicle finance at possibly higher interest rates, they can access the equity in their house to finance the car at a lower interest rate. By so doing, they can take advantage of the interest rate arbitrage or the interest rate differential. But again, importantly, they would need to have the discipline to pay the money back into the bond over the same period they would have had financed the car, or even shorter. So what are the main risks that one needs to be mindful of when it comes to leverage? The 2008 financial crisis was the perfect example of using too much leverage, where households and banks in advanced economies had high levels of debt relative to their incomes and the value of their collateral. It is therefore important to be mindful that while leverage can enable wealth creation, if not used responsibly and in a measured approach, it can destroy wealth. While this can sound complex and daunting, one can actually take advantage of this opportunity by approaching a financial advisor who can assist them in making these important decisions.